The world owes $315 trillion. Let that number sink in. $315 trillion. That's $315,000. If you stacked $100 bills to reach $315 trillion, the stack would be 213,000 miles high. That's almost the distance from Earth to the Moon. The United States owes $38 trillion, Japan owes $9 trillion, China owes $14 trillion in government debt, and another $50 trillion in corporate and household debt. The European Union owes $15 trillion. The United Kingdom owes $3 trillion. Every country on Earth is in debt. Every major corporation, every household on average. The entire planet owes $315 trillion. But here's the question nobody can answer. If everyone owes money, who exactly is owed? The answer reveals the impossibility at the heart of the global financial system, because most of that $315 trillion is owed to other debtors. America owes China, China owes American investors, banks owe depositors, depositors owe mortgages to banks. It's a circular firing squad of debt where everyone owes everyone. And the debt cannot be repaid, not because of political will, not because of economic policy, because of mathematics. Global GDP is $105 trillion. The world produces $105 trillion in goods and services per year. But the world owes $315 trillion. The debt is 3 times annual production. If every person on Earth worked for free, if we dedicated 100% of global output to debt repayment, it would take 3 years to pay it off. With no eating, no housing, no energy, no nothing. Just debt repayment. Obviously, that's impossible. So the debt can't be repaid from production. But it gets worse, because the debt has interest. At an average interest rate of 6%, the annual interest on $315 trillion is $19 trillion. That's 18% of global GDP just to pay interest, not reduce the debt. Just pay the interest so the debt doesn't grow. But we're not paying $19 trillion in interest. We're borrowing it, adding it to the debt. The debt grows by the interest amount each year, plus the new borrowing to fund deficits. Global debt is growing by $25–30 trillion per year. It will be $350 trillion within 3 years, $400 trillion within 5 years. The number doesn't stabilize? It can't. Because we're borrowing to pay the interest. This is a debt spiral. The debt creates interest. We borrow to pay the interest. The borrowing adds to the debt. The larger debt creates more interest. We borrow more. The spiral continues, and there's no way out. The mathematics don't allow it. Let me show you how we got here, why the debt can only grow, and what happens when the spiral reaches its end. In 1971, global debt was approximately $5 trillion. Global GDP was also approximately $5 trillion. Debt to GDP was 100%. For every dollar the world produced, it owed $1. That's manageable. Debt matched output. Then Nixon ended the gold standard. Currencies were no longer backed by anything physical. Governments could borrow without constraint. Central banks could print without limit. And the debt began to grow. By 1980, global debt was $20 trillion, a 4x increase in 9 years. Debt to GDP was now 150%. By 1990, global debt was $50 trillion. Debt to GDP was 170%. By 2000, global debt was $90 trillion. Debt to GDP was 220%. By 2008, global debt was $175 trillion. Debt to GDP was 280%. Today, global debt is $315 trillion. Debt to GDP is 336%. The pattern is relentless. Every decade, debt grows faster than the economy. The ratio keeps climbing, and there's no mechanism to reverse it. Here's why the debt can only grow. The global economy runs on debt, not on production, not on savings, on debt. When a corporation wants to build a factory, they don't save up profits for 10 years. They borrow. When a government wants to fund programs, they don't wait for tax revenue. They borrow. When you want to buy a house, you don't save for 20 years. You borrow. Debt is how the modern economy functions. Without new debt, economic growth stops. This sounds abstract. Let me make it concrete. In 2023, the United States added approximately $2.5 trillion in government debt. That $2.5 trillion was spent into the economy. It paid federal employees. It funded Social Security. It paid defense contractors. It became income for millions of Americans. If the government had balanced the budget and borrowed nothing, that $2.5 trillion in spending wouldn't exist. GDP would be $2.5 trillion lower. The economy would have contracted 9%. A 9% contraction is a depression, mass unemployment, business failures, social collapse. So the government keeps borrowing, not because politicians are irresponsible, because stopping would crash the economy. The same is true globally. If all governments balanced their budgets simultaneously, global GDP would collapse 15–20%. That's worse than the Great Depression. Debt isn't optional. It's structural. The system requires new debt to function, and the interest on that debt requires even more debt. Every year, the interest grows. Every year, more borrowing is needed just to service the existing pile. It's a treadmill that speeds up every time you think you're catching up. Let's look at what happens when debt gets out of control. Japan is the preview. Japan's government debt is 260% of GDP, the highest in the developed world. They've been stuck in this debt trap for 30 years. In 1990, Japan's debt to GDP was 65%, manageable. Then their asset bubble burst. Real estate collapsed. Stocks collapsed. The economy went into recession. The government responded with stimulus. They borrowed to fund spending programs. They cut interest rates to zero to stimulate borrowing. They printed money to buy government bonds. Sound familiar? It's exactly what the United States and Europe did after 2008. For 30 years, Japan has tried to grow out of their debt. It hasn't worked. The debt kept growing faster than the economy. Here's the trap Japan discovered. When debt gets too high, you can't raise interest rates. Japan's debt is $9 trillion. If interest rates were 5%, the annual interest would be $450 billion. Japan's entire tax revenue is $700 billion. Interest alone would consume 65% of all government income. So Japan keeps rates near zero. They've been near zero for 25 years. They have no choice. But zero rates create their own problems. The currency weakens. Savers earn nothing. Zombie companies that should fail keep surviving on cheap debt. Productivity stagnates. Japan has had near zero growth for 30 years, a lost generation, all because debt reached a level where raising rates became impossible. The United States is now on the same path. U.S. government debt is $38 trillion. In 2000, it was $5.6 trillion, a 7x increase in 24 years. Interest expense in 2024 will exceed $1 trillion. For the first time ever, that's more than the military budget. More than Medicare, more than everything except Social Security. If interest rates stay at current levels, interest expense will be $1.5 trillion by 2028. If rates rise, it could be $2 trillion. And here's the trap. The Federal Reserve wants to fight inflation by raising rates. But raising rates increases interest expense on government debt. The government has to borrow more to pay the interest. Borrowing more is inflationary. Inflation stays high. The Fed wants to raise more. The debt grows faster. It's a doom loop. The Fed cannot raise rates high enough to truly fight inflation without bankrupting the government. They cannot lower rates without reigniting inflation. They're trapped. This is what happens when debt reaches critical mass. All options become bad. The only question is which bad option you choose. Now let's talk about what sits on top of the $315 trillion in debt. Derivatives. Derivatives are financial contracts based on underlying assets. Bets on interest rates, currency movements, stock prices, commodity prices. They're used for hedging and speculation. The notional value of global derivatives is approximately $2 quadrillion. That's $2,000 trillion. 6 times larger than global debt. 20 times larger than global GDP. Now, notional value isn't the same as money at risk. A $100 million interest rate swap doesn't mean $100 million will change hands. Only the difference in interest rates is exchanged. But here's the problem. Derivatives create interconnection. When one party can't pay, the counterparty can't pay their counterparties. The chain of failure spreads. This is what happened in 2008 with credit default swaps. AIG had written $500 billion in credit default swaps on mortgage securities. When mortgages failed, AIG couldn't pay. If AIG defaulted, every bank that had bought insurance from AIG would take losses. The entire banking system would collapse. The government bailed out AIG with $182 billion to prevent the cascade. But AIG's exposure was $500 billion. Total derivative exposure in 2008 was about $600 trillion. Today, it's $2 quadrillion, more than 3 times larger. The next AIG will be bigger. The cascade will be faster. The bailout required will be larger than any government can provide. And derivatives are concentrated. 5 U.S. banks hold 90% of U.S. derivative exposure. J.P. Morgan alone holds $50 trillion in notional derivatives. That's 200 times their total assets. If derivatives start failing, if counterparties can't pay, the 5 largest banks could become insolvent simultaneously. The 2008 crisis would look like a warm-up. Here's the trigger. Debt crises follow a pattern: slow build-up, sudden collapse. Debt grows for years, decades. Everyone knows it's unsustainable. Nothing happens. Experts warn. Nothing happens. The numbers get bigger. Nothing happens. Then something breaks. A country can't roll over its debt. A major bank fails. A currency collapses. And suddenly, everything happens at once. In 2008, the trigger was Lehman Brothers, one investment bank with $600 billion in assets. Their failure froze the entire global financial system. The next trigger could be anything: a major sovereign default, a derivative counterparty failure, a currency crisis, a war that disrupts trade. And the system is more fragile than 2008. More debt, more leverage, more interconnection, less room for central banks to respond. In 2008, the Federal Reserve's balance sheet was $900 billion. They expanded it to $4.5 trillion to save the system. They had room. Today, the Fed's balance sheet is $8 trillion. How much can they expand? $15 trillion? $20 trillion? At some point, printing money destroys the currency. There's a limit. In 2008, U.S. government debt was $10 trillion. They borrowed $4 trillion more for stimulus and bailouts. They had room. Today, U.S. government debt is $38 trillion. Deficit is already $2 trillion per year. How much more can they borrow? At some point, lenders stop lending. There's a limit. The tools used in 2008 are already deployed. The ammunition is already spent. The next crisis will require tools that don't exist. Let me show you how debt crises end. Because they always end. The debt never grows forever. Something forces resolution. There are only 3 ways out of a debt crisis: default, inflation, or war. Default means admitting the debt can't be paid. Creditors lose, bondholders get nothing, banks fail, pensions collapse. It's devastating. But it clears the debt. After default, you can rebuild. Argentina has defaulted 9 times. They're still there. Russia defaulted in 1998. Greece effectively defaulted in 2012. It's catastrophic short term. But the debt clears. The problem with default today is interconnection. If the U.S. defaults, global banks collapse. Pension funds collapse. The dollar collapses. Global trade collapses. It wouldn't just hurt America, it would devastate the world. So outright default is unlikely. But inflation is a form of default. Inflation means printing money until the debt becomes meaningless. If you owe $38 trillion and you print $50 trillion, the debt can be paid, but the money becomes worthless. Germany did this in 1923. They had war debts they couldn't pay. They printed marks until the debt was gone. A wheelbarrow of cash bought a loaf of bread. The middle class was wiped out. Savings became worthless overnight. The U.S. did a softer version from 1946 to 1980. War debt was 120% of GDP. They didn't default. They inflated. By 1980, the debt was 30% of GDP, not because they paid it, because inflation made dollars worth less. Inflation is default on savers. You lose not because the money disappears, but because the money becomes worthless. Then there's war, not as a solution, as a cover, and as a reset mechanism. World War II ended the Great Depression. It also ended the debt structures of the previous era. Germany's debt was wiped by defeat. Britain's empire collapsed, and their debts were restructured. New institutions emerged: Bretton Woods, IMF, World Bank. A new system. War allows reset. Old debts become irrelevant when borders change, governments fall, and currencies are replaced. This isn't prediction. This is pattern. 1930s debt crisis ended in World War II. 1870s debt crisis ended in World War I. The pattern repeats. $315 trillion in debt will resolve. The only question is how. Here's what the resolution looks like. At some point in the next 5 to 10 years, a major economy will reach the breaking point. It might be Japan finally losing control of their bond market. It might be Italy breaking away from the euro. It might be the U.S. having a failed treasury auction. Something will break. When it breaks, confidence will collapse, not slowly, overnight. Because debt depends on confidence. As long as lenders believe they'll be repaid, they lend. The moment they doubt, they stop. And when lending stops, everything stops. Governments can't fund deficits. They have to cut spending immediately. 25–30% of the economy is government spending. Cut it and GDP collapses. Corporations can't roll over debt. They can't make payroll. They lay off workers. They default on suppliers. The supply chain breaks. Banks can't fund themselves. Depositors withdraw. Bank runs begin. The payment system freezes. This is what happened in 2008 for about 72 hours before the bailouts started. In the next crisis, the bailouts may not be possible, or they may require printing so much money that the currency collapses. Either way, the resolution is painful. The $315 trillion in debt represents claims on wealth that don't exist. When the illusion breaks, those claims evaporate. Someone loses. The question is, who? If there's default, creditors lose. Bondholders, pension funds, banks, insurance companies, the wealthy who hold most financial assets. If there's inflation, savers lose. The middle class who hold cash and bonds. Retirees on fixed incomes. Anyone whose wealth is denominated in currency. If there's war, everyone loses. But some lose more than others. The system will not continue as it is. $315 trillion growing to $350 trillion to $400 trillion to infinity is not possible. Something gives. Here's what you need to understand. The debt is not going to be paid, ever. There is no scenario where $315 trillion gets paid off through economic growth. The math doesn't work. The debt will be resolved through default, inflation, or restructuring. Someone will lose their claims. The money they thought they had will disappear. And the people making decisions, central bankers, politicians, financial executives, they know this. They've seen the math. They understand the impossibility. Their strategy is not to solve the problem. It's to delay it. Keep the system running one more year, one more quarter, one more day, and make sure that when the collapse comes, they're protected. Central banks are buying gold. Governments are stockpiling strategic reserves. The wealthy are diversifying into hard assets, farmland, commodities, real estate in multiple countries. They're not acting like people who believe the system is sustainable. They're acting like people who know it isn't. The $315 trillion debt bomb is ticking. It has been for decades. Every year the amount grows. Every year the fuse gets shorter. Every year we get closer to the moment when the math finally catches up. There is no way out, not for the system as it exists. The debt cannot be paid. The growth cannot continue. The spiral cannot reverse. Something will break. The only questions are when and how. If this changed how you see the global financial system, if you finally understand why $315 trillion in debt isn't a problem to be solved, but a bomb waiting to explode, then you're starting to see what's actually happening. Subscribe if you want to understand what comes after the bomb goes off. Because they're not going to tell you on the evening news. They're going to keep talking about deficits and fiscal responsibility as if the numbers still made sense. They don't. $315 trillion and no way out. The fuse is burning. The fuse is